Okay, there's some space here, so you want to sit down, please feel free to do so. Thanks a lot for being with us today. We are in the center of innovation, but we're still using paper notes. So let me introduce Grace Peter, is the head of EMEA, Investment Strategy for JP Morgan Private Bank. And it's a pleasure to have you here.
Oh, the pleasure's mine. It's so fabulous to be here. The energy is just incredible.
She's been traveling around Europe over the last weeks in a wide variety of cities, visiting a lot of clients. How is the mood out there, and what are the main concerns of the people around Europe?
The mood of the market is not necessarily as buoyant as the mood of everybody in here today. I think, quite honestly, people feel quite bruised after the last 6 months. You know, we came into the year, the developed world was poised to rebound as Omicron faded, but that rebound hasn't proved strong enough to overcome some other issues that emerged as we've gone through the first quarter. So really top of everybody's mind is the Fed, the end of easy money, as we've called this session, the war, and the upward pressure that the Russia-Ukraine war is placing on commodity prices, and still the virus. You know, when we look at the lockdowns in China, that obviously dampen growth in the region, but have global implications when it comes to supply chains, then they're really the three issues that I found clients really want to focus on, whether they be private clients or institutional investors. Because when you bring those three together, what we're really talking about is a worsening mix between growth and inflation. A slowdown in growth, a material slowdown in growth. And I think over the last 12 months, you know, if we were doing this 6-12 months ago, it was really the inflation side of that growth inflation mix that was front of mind. But now I think, you know, the market's really focused on the growth slowdown, the potential for recession, and all of that makes clients feel nervous, feel a little bruised, and as I say, not quite as buoyant as we all are here today.
Okay. So you mentioned inflation and growth slowdown and two of the main concerns. And linking both, our base case scenario is that the Fed tightening is working, that inflation might be peaking, at least in the US, and that could probably end up with no recession, or what we call a soft landing. How is your view on that, and what do you think about that? Is it possible, really?
Well, it is the base case. So, US inflation, I think what everybody's trying to do at the moment is seek out clues as to whether inflation truly is peaking or in the process of peaking. We think that it is. We think that you've seen the peak of US inflation, but that it's probably going to take a few months for people to really build confidence in that, and that we're not really going to see the numbers fall until we start to get through the fourth quarter, when we're talking about, you know, quite meaningful downward pressure. The kind of things that we're watching is on core inflation, the switch from goods into services, so used car pricing, TV prices. We've all bought a lot of stuff over the last couple of years, but now we want to go out, we want to have fun, and we are seeing some of that reflected in the inflation data. The other thing that's really, really critical is the dynamics of the labour market. One of the oddities of the recovery from the pandemic is that labour supply took a long time to come back. People didn't get back into the labour force for various reasons until more recently. But with the increase of labour supply, we've seen some of the wage inflation, quite unhealthy. You know, the Fed's described the labour market as unhealthy and hot. But with the increasing labour supply, we've seen some of that wage inflation starting to come out. That again is another lead indicator to us that inflation is starting to slow in the US. And then the next question, if you can get your head around, okay, you know, maybe inflation is starting to peak out. It's, well, how quickly does it fall, and what's the landing point? You know, when we look 12 to 18 months out, what's the landing point? You know, that we expect. And I think, you know, in light of the fact that we're not going to get real conviction that inflation has peaked, probably for another 2 or 3 months, the absolute right thing for the Federal Reserve to do in the short term is to keep hiking. So they should raise rates, we think, by 50 basis points in June, 50 basis points in July. Now, at that point, we should be able to see some evidence that inflation is slowing, and back to the growth side of that growth inflation mix, that growth is slowing quite materially. We're more concerned that too much is done, that financial conditions are too tight, and therefore that growth slows too much. We think growth in the US next year is going to be around 1.4%. That's below trend levels. That's below where consensus is expecting growth to land. And we should get more evidence around all of those factors, as we come through the end of summer. And that gives the Fed then the opportunity perhaps to step down from the pace of rate hikes, maybe not 50 basis points, maybe 25, and potentially we think a pause into the end of the year as well. And just to labour on those financial conditions, very unusually this cycle, the market has priced very quickly the Fed's intentions. Normally you see bond yields climb as the Fed funds rate climb, but now you've seen the market taking the Fed's forward guidance and applying that very quickly to asset prices and therefore into the real economy. So some quite material differences to how the Fed has acted this time and how the market has perceived that in light of this growth inflation mix. So yes, so a soft landing we think is just about feasible, despite the backdrop that I've mentioned. Why would that be? It's because of the strength of the consumer and the underlying strength of the corporate. The consumer makes up some 70% of the economy in the US and in Europe as well. The consumer has accumulated significant wealth, and thank goodness that they have. Thank goodness that they have, that they can absorb not just the tighter financial conditions from rates, but also from broader inflation and from everything else that is squeezing the consumer and will likely to continue to squeeze the consumer. So if the consumer keeps spending, we all want to come out, as they say, and that reopening part of the economy plays out. Despite the tight financial conditions, the consumer and also business investment can help engineer the soft landing.
Let's hope we keep consuming and consuming, no?
Let's hope we keep consuming and keep coming out. I mean, we spoke there to the base case, yeah. And I alluded to a bear case around tightening financial conditions and recession driven by over-tightening. So, if the base case is the soft landing, the bear case, there's many bear cases, but the most likely bear case that we see is that there is the same amount of Fed hikes, because inflation does indeed slow, but that the impact of financial conditions means that even with that level of tightening, your growth slows even more. So you end up in a recession due to over-tightening, lower inflation plus lower growth. That kind of recession, from an asset management perspective, from how we think about investing in portfolios, is manageable, because we can use fixed income to protect the portfolio in the eventuality that growth slows more, ending in a recession, but inflation falls also. The other bear case, which is a pretty nasty one, is if inflation doesn't slow, doesn't come down, all of it gets stuck at some point. Core inflation gets stuck at 4%, 3%, a number that's still significantly above the Fed's target. In that instance, then we won't have seen the peak in Fed hawkishness that is the base case. We won't have seen the peak in bond yields. And in that scenario, for the portfolio, it's pretty tricky actually, because you're going to see equities, as we've seen already year to date, move lower, and your fixed income is unlikely to protect you in that scenario as well. So, for that bear case, which we would ascribe, let's say, a 60% probability to the base case, around a 25% probability to the bear case driven by lower growth, but where inflation also falls, and maybe a 10 to 15% chance of this stagflationary, high inflation but low growth scenario. But in that situation, really it's real assets that we would want in the portfolio to offer some protection. So commodities, real estate, infrastructure. So when it comes to the US, that's how we're thinking about growth, inflation, and the portfolio in that context.
And what about Europe? Because we are in Spain, we are in Europe. The situation is different here. Yeah. We have the war extremely close. We have all the shock on the energy and commodity prices. and the labor market dynamics are quite different from the US. So how do you envisage, the growth in Europe going forward, and if it's more cloudy than in the US or not?
I mean, the key difference going through a similar running order is that inflation in Europe has not peaked. We've had the May inflation data, and I think those numbers could keep climbing through to the autumn. Inflation in Europe is more influenced, by commodities, by food, by energy inflation that is still rising. In part, that's the proximity to the war, but it's also the makeup of the economy and the fact that the housing market in Europe, we don't see the tightening of financial conditions as strongly through the housing market as they do in the US, but we absolutely do through the commodity channel. So inflation, 1 or 2 quarters behind the US, not peaking yet, but growth actually, despite all those risks, holding up, I'd say almost surprisingly well in Europe. When you look at GDP numbers, the PMIs, again, we've got the same ballasts of healthy consumers, healthy businesses because of the pandemic-related savings, but GDP, PMIs holding up quite well. So that combination of growth being quite resilient so far, inflation not yet peaking, means that the ECB is now on the move as well. And you've seen a real hawkish shift from the ECB over the last month or so, as these factors have played out. So, we think you're going to see ECB lifting off, probably with 25 basis points in the first instance, but quite possibly with 50, particularly in light of these still rising inflation prints, which means the end of negative rates for Europe. I'm sure many will welcome that by the time we get through to September, and perhaps ending the year with a policy rate in positive territory around 25 basis points and climbing further. So the risk of recession for Europe, I'd say, if the risk of the US recession, call it around a third, I think the numbers in Europe are slightly higher, but driven by different factors over the short term. The war, if we saw an oil price significantly higher, $140, $150, that's going to be very problematic for Europe. If we saw an embargo on Russian gas, that could trigger a recession in the region. So not dissimilar inflation probabilities, but I think the inputs into that quite different. So we have allocations to European assets. The European region, the European equity market, as an example, has got quite a lot of exposure to oil and gas, to commodities, i.e. where the higher prices will actually benefit corporate earnings. But I think in the region we lean in more into what we call investable themes around energy security, around food security, and around supply chain reorientation.
So with this outlook for the US and for Europe, how are we positioning our portfolios? You already mentioned some 2 or 3 key themes,
yes.
But how are we playing this? Because the market has evolved extremely quickly over the last 6 months.
I mean, speed. It's been such a fast cycle. We think that you're in late cycle. We invest according to a business cycle framework. We now put us at late in the business cycle. Late doesn't mean end, but it does mean the point that risks are rising. But the most important thing, I think, to remember when you're talking about what we see in the real economy versus what's going on in financial markets is that markets predict, markets look forward, and they try and discount today in the market what may happen in the economy in future. So I've mentioned a couple of times economic data is still robust, and yet markets are down significantly year to date, mid-teens down when it comes to equities, and even double-digit losses in fixed income, because the market has anticipated that at some point soon we're going to see quite a material deceleration in the economic data. But the same is also true on the way back up. Markets will anticipate the recovery. The data will get bad, markets are falling, and markets will anticipate the recovery up. So these are all the dynamics that we're trying to think about in the portfolio. And it's really important, therefore, that as an investor, you might need to take market risk at a time that it feels really uncomfortable because the data looks really bad. So firstly, protecting against recession risk. So thinking beyond the base case, what's the risk of recession? We want to build in defensive ballasts, playing defense in the portfolio. So increasing fixed income, so government bonds, investment grade credit, that's the first step for us for really sort of trying to prepare the portfolio for recession. I mentioned there was that scenario where inflation gets sticky, and therefore real assets, layering in commodities, infrastructure investments, real estate, or businesses that feed into higher capex. All of those can help protect the portfolio against that scenario of higher inflation. And then the other thing that probably is quite relevant to the group here today is bearing in mind that when we think about growth and innovation, this is the part of the market that has been hurt the most year to date. If we think about the S&P down 15% but the NASDAQ down 40-50%, and some companies, the real innovators, whether that be in biotech, in tech, in hydrogen, in renewable energy, the part of the market that's had real pain, not because the fundamentals have dramatically changed, but because the price the market wants to pay for future earning streams has changed. That's very interesting for long-term investors. If you're able to take a longer-term view with your capital, now is a really, really good time to work on a shopping list as the market is going through this sort of price discovery of what a higher risk-free rate actually means. So I'd say they're the sort of the four ways that we're thinking about investing, not just for today, but also for the next cycle and the key differences that we see.
Okay, let's switch gears now to a different topic, but it's always on top of mind of most of our clients. Is the situation on China and the zero COVID policy, which might seem strange, but the reality is they don't have a vaccine that is not fully working. They don't have a healthcare system that could take care of people. So what they are doing is they're locking down big cities. What do you think about China? Is it still an investment opportunity, or is it going to be like in ups and downs, in lockdowns all over the coming months?
So China, I think, is incredibly difficult at the moment to analyze and to form a really solid investment view of. I mean, the range of outcomes across the market is broader, as I hope I've spoken to, but China particularly difficult. I can make a very, very solid bull case for China. Shanghai is reopening, huge boost to sentiment. If we think about what have we learned this year in the macro data, what have the PMIs shown us, and what did we hear from the first quarter earnings season, China has been the major drag, the biggest unexpected drag to corporate America and to European companies as well. So Shanghai reopening, just as a marker in the sand, is a huge boost for sentiment. So China starts to reopen. You can't stimulate an economy that's in lockdown. So as the reopening happens, the stimulus starts to come. Remember, the Chinese government are targeting 5.5% GDP this year. We think that number's more like 4, maybe just below 4. But for them to get to the 5.5, the stimulus has to come. So let's say you get a double-digit bounce back in China GDP in the second half of the year, and that next year that continues. You can have about 5% GDP growth in China next year. I think I mentioned the US, we think, is about 1.4. Big growth differential, that's going to attract capital to China. Quite an easy bull case to make in a region that's very unloved at the moment. But it all starts with the reopening. Because if you can't reopen, if you see waves, which is perfectly feasible, as you say, Luis, in a region that's unvaccinated, where the health system outside of tier 1 cities is not particularly robust, if you can't reopen, then you can't stimulate. And if you can't stimulate, you're not going to see, that rebound in growth. And if you're not seeing the rebound in growth, then some systemic issues that are lurking below the surface could start to come to the fore. They've seen rising unemployment, particularly youth unemployment. That's at 18% now. That could be a social issue. The property market, that's 20% of China GDP, that's some 25% of bank loans. They're not used to seeing defaults, but if you see rising unemployment, defaults perhaps start to come to fruition. And I mentioned, the switch from goods to services, that's happening in the developed world. Well, that could be at the detriment to China because obviously we could be reorienting some of our supply chains, and so much of that goods-driven growth benefited China over the last 2 years. So I've given you the opposite there, a bear case on China that again is entirely feasible to believe. So when we put that together, we are mildly optimistic. We like the long-term benefits of the region. We'd start with a small position now and build up as some of those unknowns become clearer. But I think if I had to point to a region that was particularly difficult to analyze at the moment, it's China, all around the pandemic.
Okay, thanks. One other topic that I would like to touch upon, and we are all suffering day in, day out, is and you already mentioned it, the energy, commodity prices and gas prices. Most of the people blame it exclusively on the war, but there are some other reasons why the gasoline price, for example, is so hot these days now. So can you elaborate a little bit more on that and other reasons, apart from the war, why we have this peak in energy prices?
Yes. So actually, China's reopening has been another boost for the oil price. We've seen two factors start to move oil up in the last couple of weeks. The first being the Shanghai reopening, because Shanghai is such a trading port, and the second obviously being the EU's plan to ban Russian oil imports or phase them out over the end of the year. So our forecasts are predicated on oil, bouncing around between $100 and $110 through the course of this year. But the risks lie to the upside if we see material disruption out of Russia, first and foremost. If we saw all of Russia's 4.3 billion barrels of oil a day being just cut off, oil could go, we think, to $180 to $200 if there was no other supply response. Now, we think there would be a supply response, but it gives you a sense of the extent to which this commodity, could move in an adverse scenario. But I think it is too easy just to blame a higher oil price on the war. When we look at the investment into the oil and gas sector over the last decade, it's down considerably. Investment, CapEx, from international oil companies, IOCs we call them, all of the listed oil companies that you see, CapEx is down around 60% over the decade. Now, that firstly started out with companies that had too much debt being encouraged by their shareholders to focus on pay down debt and shareholder returns. That was the start of it. But then, of course, with increasing focus on sustainability, capital was reoriented away from fossil fuels and more towards renewable forms of energy, which left the sector starved of capital, and I think is also a big contributor to where we are today with a higher oil price, because we can't just increase production at a time that demand remains pretty strong. So I think when we look forward, sort of as a business, but also, as a society, whilst embracing sustainability, embracing renewable energy, there also needs to be a bit of a balance over the short term with also supporting the fossil fuel sector to an extent, because some 80% of energy usage around the world still comes from fossil fuels, and we've got to think about, yes, of course, sustainability when it comes to energy, but we also have to consider affordability and accessibility as well, as part of a fair society. So I think oil is a risk. It's also an investment opportunity to us. When we think about meeting climate goals out to 2030, we will achieve those goals with technologies that are around today. That's a period that's within reach when we think about whether it be on the supply side, renewable energy, or on the demand side, through electric vehicles, through how we utilize energy through our homes and our buildings. When we think about 2050, there are new technologies that we haven't created that feed into innovations that we're here to celebrate today.
This is perfect for my next question, because we only have like 3 or 4 minutes left. Over the last years, technology and digital transformation have been significant growth megatrends. Do you believe they still offer compelling investment opportunities?
Yeah, so when we're thinking about the portfolio beyond just 6 months, but beyond six to 12 months, if we're thinking more, 3 to 5 years, we like to think about mega trends. What are the secular trends influencing how we live our lives and how that will translate into an investable universe for our clients? So sustainability is one, and digital transformation is another. And I mentioned earlier that some of these innovation-driven sectors, including tech, have been the ones really decimated by the swift rise in rates that we've seen. So I think there's really, really good opportunities to get involved in the technology sector. I just say that the tech sector is so much larger today than it was 5, 10 years ago, and therefore the need is to be a bit more selective. I've mentioned a couple of times consumers are switching from goods into services. We think you probably want to avoid still some of the consumer parts, but business and enterprise to fend off higher input costs, whether it be wages or input cost inflation more broadly, investing in automation, in productivity. We think that the case for tech on an enterprise level is incredibly strong, both in the US but also in Europe as well. So be selective, but I think a really, really good time to invest in innovation and technology.
I think we still have time for one last question. Why don't we talk about private equity, since we are in a forum with a lot of people that are trying to get their startup. How are we seeing their role in a traditional financial portfolio? And how do we play it? Is VC, traditional?
I think when we think about alternative assets, so beyond a classic 60-40 portfolio, how do you think about giving up liquidity to access perhaps superior growth, or even as an inflation ballast? I've mentioned a couple of times that we can think about alternatives in commodities, in infrastructure, and property. They're the three ways that we really like to layer in inflation protection. And actually, when you go back to the 1970s and think about what really worked, what protected portfolios in another time where we had inflation that was higher than would have been ideal, it was the combination of these assets. Because at different points in the cycle, real assets perform slightly differently, but having those combination together really protected the portfolio in the past. Beyond just the real asset conversation, as I say, for people who don't have the immediate needs for their funds that can take a longer term view, moving more of the portfolio into private assets, into alternative assets, private equity, we think that is a winning strategy. It's been a trend in the industry already, but we absolutely think that that's here to continue, because arguably returns from those traditional asset classes in a world where the risk-free rate is higher could fall a little bit. So definitely, in our minds, worth giving up liquidity for the potential for higher returns in future.
Okay. So as we mentioned in the title of our conversation, we are facing the end of easy money, but as you've seen, there are still a lot of plenty opportunities to invest. So let's try to be a little bit optimistic into the future. And thank you very much for your attendance today, and Grace, for coming over into Spain and into this event.
Thank you all. Have a lovely day.